Hey guys, welcome to Make Money Count. Today we are going to be talking about an article that I found, something that I wanted to chat about, which is mortgage renewals. I read this article. I sent it to you. We were discussing, or it was discussing, the amount of mortgages coming up for renewal in the next couple of years and what they call the mortgage war that will ensue. I mean, they was talking about RBC and TD getting a little bit more prepped for war, you know? When I read it, I do kind of picture, the beginning of World War II when they have the big boards and everyone's kind of setting up their offensive and defensive measures. I mean, it's good. It's great to hear that banks are going to be a little bit more...
With those rakes?
Those
tiny
to
rakes,
push the little humans.
Like the one Neil has on his desk for his Zen garden?
Yeah, exactly. I picture Winston Churchill in my head just because, I don't know why. It's just the person that comes to my head, pushing the little men across the world map. But it's good to hear that the big banks are looking to get a little bit more aggressive in terms of, mortgage rates.
Yeah, like that article was a good article. It doesn't really say everything about what's going on right now, like the reason why this is going to be a rate war. We have Royal Bank, the dominant bank in Canada, and their CEO coming out and clearly stating, I want to increase our market share of mortgages in Canada heading into this period of time. We've got TD Bank fresh off the heels of a multi-billion-dollar fine.
Yeah.
Who is like banks in order to satisfy their shareholders need to grow.
Which, by the way, after that fine, I don't think their shares have gone down at all.
Well, when the fine comes in, then the shares stabilize.
Right.
The shares drop in advance of the fine. It's the uncertainty that the market doesn't like.
Of course, yeah.
But because of that, they will be looking to strengthen their position in Canada to show the growth of their portfolio, to the growth of their margins, the growth of their revenue. They're going to be more heavily reliant on Canada. So look out, Canadian consumers. They're going to be looking to get into you, to get more of your business. And we as consumers can and should and will be using that to our advantage. So it's a very unique time. In 2025, there's more than 25% of our mortgages are coming up for renewal. And even if your mortgage is coming up for renewal in 2026, you've got to start contemplating it. Like I have a mortgage that is coming up for renewal in 2026, and I am looking at it now, right now. We have clients that are calling us that are saying, okay, variable rate mortgage, tell me about it.
Right.
The prime rate is at 5.45% today. We believe quite strongly that prime rate is going to drop by another 1.5 percentage points. That's going to put you at a 395 prime. Variable rate mortgages today, they were at prime minus 120. Now they're sitting at prime minus 80 on the uninsured.
Uninsured, less than that. So prime minus 50, prime minus 60.
Oh, they've already retreated that much.
Yeah. Insurable, we can still get you down. If your mortgage is coming up for renewal and you don't live in a castle and your mortgage is less than a certain, percentage of your home's value, then we can still get you prime minus 1.1, something like that, which is...
Sorry, why are castles exempt?
The value.
So what?
The value has to be under $1 million.
Under $1 million.
Yeah.
Not $1.5 million because of the new increase?
No. So that only counts for insured mortgages. I've been speaking to a bunch of people about this because, rules changed. You can now put less than 20% down on insured mortgages. We know that. We've talked about that a few times. There is a type of mortgage that basically follows the guidelines of insurability, but those that between $1 million and 1.5 is exempt from that insurable mortgage.
You know what's crazy? Is that there is no good reason why the variable rate mortgages, the rates, are seeing that increase in margin. There's absolutely no good reason for it financially in the markets, economically. But here's the reason for it. Because consumer demand will start shifting so considerably towards variable rate mortgages, banks are going to look to take more profit on them.
Of course.
It's just a squeeze for more net interest margins. So more and more Canadians, like myself, like Justin, are going to be stuck in a position where your bank has you in a fixed rate mortgage with a significant penalty to break. Say, for example, your mortgage is at 5.75% and you have another 18 months left on it. You're going to be weighing an option whether or not you should be breaking your fixed rate mortgage so that for the next 18 months, you can take advantage of rates that are considerably lower than your 575, right? We just said prime rates at 545. If you took a variable rate today, you might be able to get in at 465. So it's about 1 percentage point lower. You're going to have to start thinking about a complex math problem. And that math problem has two sides to it. One side is easily quantifiable, okay? Let's think of it like this. One side of it is the difference between the penalty you have to break your existing mortgage and the savings associated with breaking it. So let's use for an example someone that has a 5.75% 5-year fixed rate mortgage with an ability to switch to a variable rate mortgage that would be at 80 basis points below prime, which would bring them to a 4.65% variable rate mortgage. The difference there is 110 basis points. For easy numbers, let's make it $1 million mortgage. The savings associated with switching 1.1% times $1 million is $11,000 in interest annually. If you have 18 months left, that's $16,500 in savings if you switch and drop the hammer right now and switch to that new mortgage. Okay. The problem is that mortgage that you are breaking will have a penalty on it. Depending on your bank, depending on the interest rates that are in the marketplace right now, that interest rate penalty is likely to be what's called interest rate differential, which is the difference between the interest rate that you are paying on your mortgage and the interest rate that the bank can lend that money out for on a term that is equal to the remaining term of your mortgage. So for this client that we've got that has 18 months left, the bank would price that off of a 2-year mortgage contract. So they would say, on the day that you got your mortgage, we gave it to you at 5.75%. But the prevailing rate on that day was 6.5%, like the bullshit posted rate that's on the bank website. Hence, we gave you a 0.75% discount on that day. Well, they'll take that discount and they'll apply it to the posted 2-year rate to arrive at the difference. So they'll say, rate when you got it was 6.5. We gave you 575. Rate on the 2-year right now is, I don't know. What's the rate on a 2-year? 4.5?
No, 5 something.
5.5.
Yeah.
Less the 75 basis points. That differential is what you are responsible for. And if that differential is higher than 3 months worth of interest on your mortgage, then that's what you're paying. If 3 months worth of interest is higher, then that's what you're paying. So first thing you're going to do is you're going to weigh the difference between your penalty and the savings associated with switching. The next thing you have to consider, which is more difficult because one of the variables is somewhat unknown. We know that variable rate mortgages are going to get more expensive. We know already, like variable rate insured mortgages were at prime minus 110. Now they're at prime minus 50, 60. That's
uninsured.
Yeah.
Prime minus 50, prime minus 60.
horrible.
Yeah.
So now they're at prime minus 60. We already lost 50 basis points off of the variable rate mortgage. We're going to continue to see that compression happen. We're going to continue to see the banks take more and more of that net interest margin off the table. So you have to quantify now what happens if your penalty, remember, we're going back to this 5.75% mortgage that needs to get broken, put into a variable rate. The savings associated with doing it are $16,500. What happens if the penalty is higher than the amount of savings associated with that switch? Well, then you have to quantify what the difference is going to be if you wait that period of time, and what will the variable rate mortgage be at that time. So 18 months from now, when we will see interest rates be considerably lower than now. Will the variable rate mortgages still be at prime minus 50 or 60? Okay, then there's one more thing you got to consider. Because we calculated our savings based on a prime rate of 545. How many interest rate drops are we going to see over the course of 2025 in order to provide you with further savings associated with that product? I think we're going to see 4 minimum, maybe 6, bringing that prime rate down from 5.45 to 3.95, or worst case scenario, 445. So you've got to take into consideration that rates are coming lower and variable rate mortgages are getting more expensive. If you sit and wait on this, the bank wins. If you don't, you win. So right now we are being told that the banks want to fight for your business, right? We know TD scrambling for market share. We know RBC wants to come in guns blazing. Hopefully we see some more competitive rates coming out in the spring, which is usually when the banks like kind of clamor for business. But I think we're going to see that competition on the fixed rate side,
Right.
not as much on the variable rate side.
Right.
And we're going into a period where like it is so improbable that rates stay where they are or go higher.
Right.
So like if we can all agree on this thesis, right? Like rates are going considerably lower still. We're not going to see, probably not going to see 50. Listen, if we see a tariff come from the States, which we'll talk about in our next podcast, but if we see a tariff come from the States, we'll start seeing another 50 basis point jumbo rate cut.
Right.
It's going to decimate our economy.
Terrible.
Yeah. So listen, our job is to make sure that you are informed. And you in the way too many years, 23 years that I've been doing this, there have been certain kind of critical points for Canadians and their mortgages, and this is one of them. Right now, you've got to be prepared, and you've got to be ready to switch, and you've got to be ready to fight. Because remember, there's a few things here, right? Like your mortgage is your after-tax money for most of us. It's your after-tax money. And if you have $1 million mortgage, we're talking about a $10,000 swing, $16,000 swing, more of a swing if you're taking into consideration rate drops.
That's the biggest raise you're going to get in a long time.
It's a huge rate. But you're also, the penalties are designed to make you fearful.
Right.
Right? The penalty, like imagine, like, okay, you listen to this podcast, you're at home, you're like, oh my God, okay. The guy in the blue cardigan, which you hate, by the way. You hate the blue cardigan.
I didn't say that I hated it.
Yeah, okay. I don't care. Whatever.
Okay.
The guy in the blue cardigan says we should break because rates are going lower. The banks are going to if you believe that the banks are going to get greedy and that interest rates are going to go lower, then you should probably start thinking about breaking your mortgage, right? Okay, so we're going to break our mortgage. You call your bank up. I need to know what my penalty is. First of all, if your bank gives you a penalty over the phone, ask for it in writing. You need it in writing and send it to someone that knows how to dissect these penalties because how often do we see those penalties come in? Oops, we made a mistake.
Yeah.
Oh, well, sorry about that.
It very significantly happened recently with one of our clients, and it was like a $20,000 difference, and they had to go back to what they said on the phone.
Yeah.
It was amazing.
It's crazy.
Yeah.
Crazy.
Yeah.
Like the banks don't behave the way you would expect them to behave. Okay? They behave in order to maximize their profits. Right now, the banks are licking their chops at the thought of getting penalties from you. They are scared at the thought of reducing the net interest margins on their portfolio. Because they got a whole bunch of mortgages that got locked in at 5.5%, 6.5%, 7%. And those people, you want to break those mortgages in order to get to lower rates, or your mortgage is just naturally coming up for renewal. Keep in mind, you might have an early renewal option. You might want to hold a rate out. You might want to lock something in when your mortgage comes up for renewal. Whatever it is that you need to do, you need to make sure that you are your advocate. It's like healthcare, right? Like you can have a doctor and a great doctor, but if you're not your own advocate, you're screwed. Right? Like in Canada, you need a mortgage broker and you need to get involved. You need to roll up your sleeves because you're going to get hit with a penalty to break a mortgage, and they're going to tell it to you over the phone. It's going to be like, if it's $1 million mortgage, they're going to say it's like 20 grand. Okay? It's like everyone's got a plan until they get punched in the face. Yeah. Everyone wants to break their mortgage until they get told what the penalty is.
Yeah.
Right?
Yeah.
And then someone's telling you, yeah, you can break your mortgage. It's going to cost you 20 grand. And you're like, 20, but I'm only saving nothing now. Right?
Negative.
Yeah,
negative,
so
negative.
20 grand with our $1 million mortgage. If there's a $20,000 penalty, it might not be 20,000, but probably pretty close. Then you're losing $3,500 by making that switch.
I mean, that's where the crystal ball comes in, right?
Right.
The future.
Yeah.
What does the future have to hold?
Yeah. Remember we did that?
Yeah, that was fun.
That was a good episode. Actually, if you want to flip back, we did an episode where we both pretended to be Nostradamus.
Yeah.
Uh,
Podstradamus, we like to call it, actually.
You like to call it that.
I do.
Anyways, I get so worked up about this stuff, but like really, I just want you to know that your bank is going to try to screw you. They're screwing you now. And if you try to break your mortgage, they're going to try to screw you. Any interaction that you have with them, rest assured, they are not looking out for your best interests. The only thing they want to do is get as much money from you as possible. Remember we talked about the bank profits?
Yeah.
How do you think the banks make almost $2,000 of profit for every single human being that lives in Canada?
By screwing us.
Yeah, it was not by like calling you up and informing you that you could get a better interest rate and there's an opportunity to save money.
Like taking us out for a respectful dinner and dropping us off at our parents' house at the end of the night, at the end of the driveway. They're coming in. They're coming in.
To the parents' house?
Well, I don't know. I just picture like that kind of date ending with you going back to your parents'
That's
house.
a good analogy.
Yeah.
Yeah.
You like analogies.
Yeah, I do. So then like the mortgage broker would be the dad or the mom at the house.
Yeah. What are your intentions with my
Yeah,
daughter?
you're not coming into this house.
Yeah.
Yeah.
Yeah. Stay there.
Yeah.
Or I'm leaving in a police car.
Yeah. Go get the strap on, Sally. We're going to turn this sucker around. I don't know if that makes it. I don't know if that makes it into the final cut, but if it does, maybe you will like or comment whether you think we should get more or less vulgar in this podcast dedicated to mortgages.
All right. I think that's it. To break it down, if your mortgage is coming up for renewal, and even if your mortgage is not coming up for renewal, get in touch as soon as possible. Let's figure out what your options are. If you're looking for a variable rate, have the conversation sooner than later. And let's save you some money. And let's keep your money out of the bank's hands. Right?
Yeah, listen, your hair is on fire, right? Like our hair is on fire. Collectively, our hair is on fire.
Everyone's hair.
We have negative headwinds in our economy. We've got unemployment rising. We got interest rates falling. You can do very few things to protect yourself and your family and your wallet and your finances for the future. One of those things is to take advantage of advice relating to the largest asset and the largest piece of debt you likely have. Mm-hmm. And this is one of the most critical times because we got like 35% of all mortgages coming up for renewal in the next 12 months. And if your mortgage is coming up for renewal, or if you're in a high rate, you're going to have to start considering getting into a variable rate mortgage. Do not let them sell you on a fixed rate mortgage right now. Make sure you don't get overcharged on your mortgage penalty. That's it. Bye, everybody. See you later.